Good day. Today we are going to learn about the income statement. So we are told to complete the income statement for the year 31 March 2019. Okay. So we have the sales, which is 10 million. The sales is 10,563,280. And then the cost of sales is 6,236,000. There, the sales and the cost of sales. So let's go to the adjustments. Adjustment number 1. A credit invoice for 36,720 issued on 31 2019 was not recorded. So let's go and record it. We sold the goods, but we did not record. So it's 36,720. So you know that if we are selling the goods, the sales will be affected. So it's 36,720. Remember, they said after deducting a 10% trade discount, and then the goods are marked up at 70% on cost. So we need to find the selling price. We need to find the selling price before the trade discount. Before the trade discount was deducted. So to do that, we're going to say below we're going to put what we have. So because we have subtracted that 10%, meaning that the remaining one is 90%. So now we are looking for the 100%. So how much is 100%? Let's take the calculator. So it's 36,720 times 100 divided by 90. So is equal to 40,800. So this is the selling price before the 10% trade discount was deducted. Now we can calculate the cost of sales. So because the markup is 70%, so you know that the cost plus markup is equal to selling price. So the markup is 70, your cost price will always be 100. So therefore, your selling price is 70. So what we have is a 40,800. So below we put what we have, which is a 170, the selling price. What we don't have is 100, which is the cost of sales. So 40,800 times 100 divided by 170 is equal to 24,000. So is equal to 24,000. This is the money for the cost of sales, 24,000. So plus 24,000. So if we add these two, we are going to get a 10,600,000. Then if we add these two, we are going to get 6,260,000, which is going to get us a 4,340,000. Because to get the gross profit, you say sales minus cost of sales. Let's continue. Let me erase this first. Let me just erase this first because now it's a mess. So erase it first, then we can continue. Yeah, okay. So the physical stock count on date 1 March 2019 revealed the following. Okay, let's go to our trading stock. How much is our trading stock? The trading stock is 364,200. Remember, there was a transaction that was not recorded. We sold the goods on credit, but this was not recorded. So if we are selling the goods, obviously the trading stock will decrease. So how much is for the trading stock? It is 24,000. The money for the cost of sales. Remember, the cost of sales and the trading stock, they go together. So if you are selling the goods, the cost of sales, they increases. So this is your cost of sales. This is your trading stock. So if you are selling the goods, obviously the trading stock will decrease. The trading stock decrease on the credit side, and the cost of sales will increase. So the cost of sales and the trading stock, they go together. Okay. We want to find out that how much is the trading stock left. So 364, 200 minus 24,000 is equal to 340. And if you can look, so it's 340, 200. And if you can look, the physical stock count on date 1 March 2019 revealed the following. The trading stock is 334,500. This means that here we have a trading stock deficit. So we have a trading stock deficit because the trading stock is less. So we have a trading stock deficit. So 364, 200 minus 24,000 minus 334, 500 minus 334, 500. So trading stock deficit is 5,700. With the consumable stores, how much is the consumable stores net trade balance? Is 53,200 consumable stores. 53,200 minus. So to get the consumable stores use, so what you must do is you take the money in a trial balance and then you subtract it with the consumable stores on hand. Then you are going to get the money for the income statement. So we're going to subtract this money for the income statement, which is 3,400. So it's 49,800. And then the next one. So let me just erase this first. Let me erase this first. Okay. A debtor is one was declared insolvent. Debt is a bad debt. How much is a bad debt? So the bad debt is 22,300. So we have the bad debt So it's 22,300. 22,300. And then they are saying here that a debtor as Magnum was declared insolvent. His estate paid 2,000. So his estate paid 2,000, which was 20% of his debts. Then they are saying the difference must be written off as bad debt. So they are saying that this 2,000 is 20% of his debts. So I said below we put what we have. So what we have is a 20%. So if his estate paid the 20%, meaning that the 80%, which is what we're looking for, is going to be written off. So 2,000 times 80 over 20, 2,000 times 80 divided by 20 is equal to 8,000. So this is the money for the bad debts plus 8,000. This is the money for the bad debts. So the answer is 80,300. The next one, 1,800 was received from a debtor G. Nesting, whose debts had previously been written off. So we receive a money from a debtor who was previously written off. That is a bad debt recovered. The bookkeeper incorrectly recorded the amount to the debtor's control. Correct the error. So how much is your bad debt recovered? It's 6,000. So we're going to the bad debts recovered. So it's 6,000. And then we have a new one, which is 1,800 plus 1,800, which is going to be 7,800. The next one, adjust the provision for bad debt to 28,000. Now let's check if we provided more or less. So on 2018, so a provision for bad debt was 80,100. Now the provision for bad debt is 28,500. This means that now we have provided less, which is the income. So we have the income. So the provision is 30,100. Provision for bad debts. So it's 30,100. We want to find, so minus 28,500. Minus 28,500, which is 1,600. Let's continue. Insurance includes, okay, let's go and check our insurance first. The insurance, 79,500. Insurance is 79,500. So what are they saying about the insurance? Insurance includes an annual premium of 51,000. Okay, 51,000 times, okay, annual premium of 51,000 paid for the period of 1 January 2019 to 1 December 2019. So let's check our year. So our year ends on 31 March 2019. Our year ends on 31 March 2019. This means that from 1 April 2019 to 31 December 2019, this is a next financial year, meaning that we created a prepaid expense. So now, how many months are prepaid? Is April, May, June, July, August, September, October, November, December. 9 months are prepaid. So we need to go and separate those 9 months. We need to go and separate those 9 months. So let's calculate them. Let's calculate them. So 51,000 times 9 divided by 12 is 38,250, which is the prepaid expense. So minus 38,250, which is 41,250, 41,250. And then let me erase this. Let me erase this. Let me erase this. An employee was left out of the salary schedule for March 2019. The following details are applicable. Net salary for the employee. Okay, let's just do this first. How much is our salary? The salary is 1,280,000. Salaries and wages 1,280,000. And then we also have the employer's contribution 316. Employer's contribution, which is 316,000. So let's go back there. Okay, so an employee was left out of the salary channel for March 2019. The following details are applicable. Net salary for the employee is 9,000. So now let's go and edit. So it's 9,000 plus 9,800. And then you see the deductions by the employee total to 30% of the gross salary. So we are given the 9,100 times. So we are told that the deduction by 30% of the gross salary. So remember, to get the net salary, you say gross salary minus deductions, meaning that because the deductions are 30%, it means that the net salary is 70%. Remember, I said below you put what you have. Now, what we are looking for here, it's the gross salary. What you're looking for here is a gross salary. So obviously the gross salary is 100%. So 9,100 times 100 divided by 70 is equal to 18,000. This is the gross salary. So we're supposed to do it like this. So it's 18,000. Okay, I said 9,100 times 100 divided by 70. Yeah, that is 13,000. So this is the gross salary. So now to get the deductions, we are going to say 13,000 minus 9,100 minus 9,100 is equal to 3,100. These are the deductions. So remember, the money that is going to your salary. It's a gross salary. So because we only added the net salary, we must also add the deductions. We must also add the deductions, which are 3,900 plus 3,900, which is equal to 1,293,000. And then again, employers' contributions were 2,200. So let's go and add them. Plus 2,200, which is going to give you 318,200. Okay, let's continue. Interest on loan is capitalized. Interest on loan is capitalized. A fixed monthly repayment including interest of 25,400. So they were supposed to say 254,000 here, not 25,000. 254,000. They were supposed to say that. Now let's go and check our loan. Let's go and check our loan. So the market bond, um, in 2018, it was 1,658,000, and then in 2019, it is now 1,430,200, meaning that the business paid. So let's calculate that how much did the business pay? Because if you can remember, they said interest is capitalized. Minus 1,430,000. We want to check that how much did the business pay? So the business paid 228. Okay, seems like okay. Seems like okay. It's 1,658,000 minus 1,430,200. The answer is 227,800. So the business paid this money, but according to the transaction, the money that the business paid, including the interest, is 254. The business paid 254, including the interest. So now to get the interest, we are going to find the difference. So 254,000 minus 227,800 is equal to 26,200. So this is our interest on loan. So it's 26,200. This is our interest on loan. Let's continue. Fixed assets and depreciation. Number one, vehicles. Let's see. Number one, they were told that the difference for three vehicles are shown as follows. Number one, we are given the vehicle number one, which is the cost price of 250. It was purchased on 1 October 2013. So it's a 20% annum times 20% is equal to 250 times 20% is equal to 70,000. But now if you can check, if you're going to add the, if you can check, um, if you can check the accumulated depreciation and the depreciation, if you can add them, you could see that they are exceeding the cost price, which is not right. So we're going to say 350,000 minus 350 is equal to 350,000 minus 315,000 is equal to 35,000. So the vehicle, we were supposed to depreciate the vehicle by this amount. But because we are not supposed to leave the vehicle with a zero value, we are supposed to leave a vehicle with at least a 1 rand value. So we're going to subtract a 1 rand. So meaning that the remaining amount here is going to be the depreciation. 34,999 is the depreciation. 34,999. And then the next one, let me erase this. The next one, is the vehicle number 2 of 400,000. We are given that they depreciate on 20% on cost. So we are not supposed to minus it. We are not supposed to minus the accumulated. So 400,000 times 20 divided by 100 is equal to 80,000. This is our depreciation plus 80,000. The next one, let me erase this first. We have a vehicle with a cost price of 627,000 times 20% times. So this vehicle stayed for, it was purchased on 28, on 30 November 2018, and our year ends on 31 March 2019. So this vehicle stayed on December, January, February, March. This vehicle stayed for 4 months. So which will be a 41,800. So this is our depreciation plus 41,800. And then the equipment. Equipment was sold for 9,600 on cash. Okay. We are given the depreciation. It's one for the current year. It's 1,750 plus 1,750 plus Depreciation on the remaining equipment is calculated at 92,000 after all the above account. So it's 92,500. So which is going to give you 4,000 plus 80,000 plus 41,600 plus 1,750 plus 92,500, 251 and 49. Okay. Interest income is missing as a missing figure in the income statement. Okay. Meaning that is going to be a balancing figure. Okay. Okay. I think we have written all the expenses here. So now what is left is we need to calculate. We need to calculate. So 99,500 plus 7,800 plus 1,600 is equal to 108. 900. Oh, we forgot something. We forgot something. We forgot something. We forgot something because here there's something that we need to do. So this is your asset disposal. So the equipment that is sold at cost price of 28,000 and then its accumulated depreciation is 21,500 and then it was sold on cash by 9,600. Now which side is greater? Which side is greater? 21,500 plus 9,600, 31,100. So the credit side is greater. Now, how much is the difference? Minus 28,000, which is 3,100. This is the profit on sale, which is an income. This is the profit on sale. So it's 3,100. Let's calculate again. 3,100 plus 1,600 plus 7,800 plus 99,500 is equal to 112,000. So 112,000 plus 4,340,000 is equal to 452,000. 4,452,000. Now let's add all of this. Let's add all of this. Okay, let's add them all up. Okay, 1,626,100 plus 218,000 plus 75,600 plus 104,000 plus 61,000. Okay, let's start again because it seems like I made a mistake. Okay, 1,262,100 plus 218,000 plus 75,600 plus 104,000 plus 61,001 plus 5,700 plus 49,800 plus 80,200 plus 41,250 plus 1,293,000 plus 318,200 plus 251,049, which is equal to 3,710,000. Now, to get the operating profits, we're going to say 4,452,000 minus 3,710,000. We're going to get 742,000. 742,000. So we don't have the money for the interest income. But then you know that to get the net profit before tax, we say profit before interest income. Okay, we say profit before interest expense plus the interest expense, then you get the net profit before tax. So now it's a vice versa. We're going to say net profit before tax plus interest expense. So 691 plus 26,200, it is 710, 717, 200. Remember I said to get the net profit before tax, we say profit before interest expense minus interest expense, then you get the money. But because we are not giving the profit before interest expense, but you are giving the net profit before tax, we are going to say net profit before tax plus interest expense. Again, to get the profit before interest expense, we say operating profit plus interest income. But because we don't have the interest income, we are going to say operating profit minus profit before interest expense. We are going to say operating profit minus profit before interest expense. So we're going to say 742,000 minus 717,200 is equal to 24,800. We're almost done. Now we're only left with the income tax. Let's go and check what are they saying about income tax. Income tax is calculated at 28% of the net profit. 28% of the net profit. So the net profit is 691,000 times 28%, 691,000 times 28 divided by 100 is equal to 193,480, which is the income tax. 193,480 480. Now we know that to get the net profit after tax, you say net profit before tax minus income tax. So 691,000 minus 193,480 is equal to 497,520.